The biggest risk when it comes to investing is not doing it, with the result you won't have built up a big enough nest egg to have a comfortable old age. Saving isn't going to build wealth, given that the rates you are likely to earn are less than inflation. That leaves you with either spending your money or investing it. And clearly, spending isn't the way to get the job done. And yes, investing does involve risk, but there are ways to manage this, and in this video, we will take a look at them. Hi there, welcome to my channel, where we talk money and having more of it. In this video, we're going to take a look at reducing your investment risk so you can sleep comfortably at night. Clearly, investing does have risk. We basically get this blasted in our face on any investment platform, where we are constantly reminded that investing is a risk and we may not get back what we have invested. And this is not exactly the introduction you want when you're starting out investing. But as I said in the intro, the alternative is to save your money, which is an even bigger risk because it loses its value with inflation, or just spend it. Both of these options are not likely to lead to a stable financial future. However, as with anything in life, there is risk, but we have the tools to reduce it. Wear a seatbelt when driving your cars. Don't cross the road in dangerous places, and so on. Same for investing. So, let's understand what investment risks we face and what tools we have to manage them. Firstly, let's understand investing risk. Investing risk is the risk of an uncertain return. You invest your money in assets that could grow in value and increase your wealth, but this is not guaranteed. And usually, a higher return comes with higher risk. Furthermore, there is no guarantee you will ultimately get back what you invested. That sounds horribly scary. So let's take a look at those tools I mentioned that manage this risk. The first tool we have for managing risk is diversification. This is all about not putting all your cash into one investment, or the more popular phrase, not putting all your eggs into one basket. The key to managing your investment risk is to build a diverse portfolio with a mix of different investments that make sense for your attitude to risk. Ideally, you want to create a balanced investment portfolio containing a mix of equities, being shares in companies, government and corporate bonds, being sort of quasi-loans to the government and to companies, property, and cash. And you want this mix to ideally be across different industries and different geographies. The idea behind this approach is that the value of different assets can move independently of each other, and they often move for different reasons. Shares generally move in line with how companies are performing or how investors perceive they will perform in the future. Bonds are considered a safe haven when the market looks like it's going to underperform and it may be slowing down. While property values, although also to some extent influenced by interest rates, are also very closely connected to the performance of their domestic economy. By creating a diversified portfolio across all these different moving assets, you set your portfolio up to provide a reasonable return no matter the market conditions. And an easy way to achieve this diversification is by investing in funds. I have a video taking a look at how to create an easy beginner portfolio, and I invite you to take a look at this and to see how easily you can create a balanced portfolio. The second tool we have is time. Research has shown that if you're invested for a long term, it reduces your investment risk, because even though the price of any given investment may rise and fall over a short period of time, it generally will gain back any losses over the long term. Investing is a long-term strategy for long-term goals, typically 5, 10, 20 years and so forth into the future. Take a look at this S&P 500 over the last 40 years. And you'll see, while there has been some extremely bumpy periods over time, the trajectory is upwardly sloped as companies become more efficient and new innovations and technologies get introduced. And again, because you and I don't have a crystal ball and cannot see into the future, well, if you do, please share. But by investing in index funds, we take the guessing game out of trying to pin down which companies or which investments are going to be those that outperform over time. And the third tool we have is regular, consistent investing. One way to make the most of investments over time is to commit to investing a certain amount on a regular basis. This means that sometimes you'll buy into the market when it's high and sometimes you'll buy when it's low. But since markets generally rise over time, you'll do very well over the long term without playing the guessing game as to when to get in and out of the market. This is not to say, though, it isn't a good plan to put that little bit extra into the market in the periods when it is down. The final tool is your mindset and knowing yourself. When it comes to investing, the biggest influence isn't what you know, but how you behave. And this means knowing yourself, understanding your triggers and your biases, and mitigating against your natural reaction. The market is dropping. The news is publishing Armageddon is near, and your natural instinct is to protect, to huddle, to remove the risk and the stress, and so you sell. You have just turned a paper loss into a real loss. And as the saying goes, the worst days in the market are often followed by the best. The market dropped by 50% during the global financial crisis of 2008, and investors who didn't understand their risk tolerance panicked and sold out. The drop was rapidly followed by a huge recovery and 12 years of outsized market performance. Don't let this happen to you. Understand how much risk you're comfortable with and structure your portfolio accordingly. But remember, with risk comes reward. So to balance this, to achieve the return that you want, you have to take a certain level of risk. Another thing to do, don't watch your portfolio daily. While you need to review your investments regularly, if you've got a diversified portfolio and a sensible long-term plan, you don't need to rebalance your portfolio more than 1 to 2 times per year. If you are ready to get started investing and want a little more info, grab the Investing 101 guide down below. If you like this video, please let me know by liking it and share it with any other ladies who want to change their financial story. For financial education and money talk designed for women, please subscribe to my channel and hit the bell to be notified of when I post a new video. Thanks for listening.